So what we've got now then is a reminder of how to calculate that adjusted profit. So with a company, your financial statements will be a little bit more complicated than a sole trader, because sole traders just simply say sales less expenses and you just get a profit at the end, whereas a company, as you've seen in financial reporting, you know, you've got more detail in there. So the profit that you're picking up is the profit before tax, the final profit at the bottom of the statement. And then you will add back your disallowable expenses, and there's a summary here of the key things that you might add back. So we've seen most of these before: depreciation, losses on an asset, entertaining anybody other than staff, gifts to customers, generally professional fees that are non-trade, like capital fees, rent and rates with premium adjustments, charitable donations other than the local charities. And then we would deduct anything that is basically non-trade. So all of these things here are non-trade: dividends, interest, rent, and possibly your profits on the sales of an asset, because that's replaced by your capital allowances. So I'm just going to reference here that it might be useful to revise your chapter 5 again. You'll then take off your capital allowances. So that's where you split all your additions and disposals into your main and your special rate pool. So it might be worth looking at your chapter 7 again. And then finally, this is what we call your trade profit, which is what's going to go into that corporation tax computation. So we would take that trade profit. So that's what we had on the previous page. If we've got any losses brought forward, and this is something you'll do in your chapter 17 very, very briefly, because you just expect to have an appreciation here. But if you've got any losses brought forward from previous periods where you didn't pay any tax and you want to claim relief for it, then that could be deducted. And then you're going to add your other types of income. Now, it looks a lot more complicated here than it needs to be. So let's just flag up the key points. So you'd add any what we call non-loan relationships. So this is, in simple terms, any non-trade interest minus any non-trade expenses. So your non-trade interest and your non-trade expenses for interest, should we add that, will be anything that you've adjusted for up here. So if you've got any interest received that you've disallowed because it's nothing to do with the trade, or you've got any expenses up here for interest that you've disallowed because it was non-trade, then they just go in at a separate line here. Miscellaneous income that you've got, that could be things like, just thinking what business might have as miscellaneous income. I suppose it could be like overseas dividends, possibly. You've then got your property income. So that's pretty much the same as what you did back in chapter 3. And then any capital gains, which we've also covered quite recently in this new booklet. So when we sell an asset, we'll do a refresher of that in a minute. So the summary that you've really got is what I've shown you a couple of times now. You've got your trade income, which is your income after your capital allowances and all your adjustments. You've got your interest calculation, which is this non-trade loan relationship, this bit up here. You've got any other income you might have, like property and any gains. Okay, and then you've got this figure here, which is going to be your TTB. Right, and TTP just stands for your total taxable income, total taxable profits, I should say. Yeah, and then when we've got that figure, we're going to pay tax at 19%. We're not going to worry about trying to split it into financial years or anything like that, because the rate has been the same for a number of years. There are other bits and pieces that you've got at the bottom of here. So it's just reminding you that if you've got any losses of any description, to deduct them. To be honest, the only one you might see is these losses brought forward. We're not going to be testing you on any of these other special rules. But if you've got any losses from a property or some interest, let's put that in brackets, anything they've brought forward from a previous year, then you will get relief by deducting them. This line here is new for a company, so we've not seen this with an individual. This is often referred to in your notes as a QCD, qualifying charitable donation. And this is where you've got some gift aid payments. And these gift aid payments were an example of a disallowable expense when we looked at trading income. So up here in the trading income, if we had any gift aid, we disallowed them because they're not to do with the main the main trading activity. The only charitable payments we allow for a company is local donations. So we disallowed them up there, but we are allowed to deduct them if we've got some profits. Obviously, if we haven't got a profit, you can't deduct them, and you can't get relief for them. So that's why they're done much lower down. And then you can cross out the group relief. All right, we don't need to have the group relief in. It's not examined at this level. This is something you'd do at higher level for advanced tax. Now we've got something in a little box down here, and I'm going to write next to this. You use this to test the company size. Now there is a whole section on this much later in the chapter, but basically your total taxable profit is what you pay tax on. So that's what we had up here, this TTP. So that's what you pay tax on. But what a company does is they add on any dividends that they've received to test the company size. So this figure here, they test the company size. And the only purpose of this is determining when the company has to pay the tax. So for example, a large company would have this augmented profit that's greater than or equal to 1.5 million. And a large company must pay tax in instalments. And I'm not going to go into any detail because, as I say, it is later on in the notes. Any company that's not large, i.e. less than the 1.5 million, they pay their tax in one lump sum, and it's 9 months and 1 day after the year end. So if, for example, my year end was December 19, all of my tax would be paid on the 1st of October 20. So the only purpose of this little box here is to test your company size. So if you were given a question where they said to you, right, work the tax out, and now I want you to tell me when I've got to pay it, you just have to do this little bit at the end. But remember, these dividends, they are exempt from tax. So these dividends received are not in this computation here unless they're overseas dividends. So UK dividends are not taxed for a company, but they are used to test the company size because they are part of the company's income.